investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. This is a 1-year daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. And I've left my lines on the chart like I do each and every week so you can see how the forecast has worked out. And this week we hit on all of our targets and then some. This diamonds chart, as you can see, as I zoom in here, you'll see that my line that I drew as the forecast is right here. Let me just scroll in just a little bit right there. I'll highlight that for you. With the end of the line being my target. And again, if you're new to the Market Guys reports, I'm just repeating that so you know over and over again that when I draw a line, the end of the line is the target. And we hit that target on Wednesday, hovered around that target on Thursday, and today, if you look at this low, we are right at the former support level back here, which is a gap fill point. Now let me erase all of these lines so you can see exactly what I'm talking about for next week. Just going to clean this all up for you. This is a gap. You can see that from this high to this low on June 18th is a small minor gap. It doesn't matter how big or small the gap is, 80% of the time those gaps fill. And so as you can see from today, that gap has filled. Now, the second part of the equation for gap trading is that once a gap fills, there's an 80% chance that the stock will rally. And that's what my forecast is going to be for next week. If President Trump just can stay away from his tweet button there, we'll do just fine next week, because I think that that gap fill will allow us to find some support. But if you look at today's candle, that is a perfect hammer pattern. A hammer pattern is a small-bodied candle that has a long shadow underneath that candle that's 2.5 to 3 times the length of the body. And again, that's textbook. The small minus shadow above that candle really doesn't matter. It's the shadow underneath that matters, because it tells us that the sellers tried to push it down today and the buyers rallied back. Now, there's a lot more going on this chart than I've just mentioned. First of which is that there's a wide divergence from this 20-period moving average. And you'll notice in the past, if the market moves that far, it generally snaps back to it. Hence the reason why we call that the rubber band effect. Okay, so that's another positive indication there. We see a drop in volume as the market has been dropping. And that is positive because it tells us that the sellers are running out of that momentum. Stochastics, going right down the line here, is now showing oversold. The CCI is showing extreme oversold, but now the CCI is starting to turn up, and I'm going to forecast that next week the CCI will even move back up over the minus 100 mark, which would create a buy signal. So everything is looking positive for the Dow. And let me go right to the VIX. Volatility index is a contrarian indicator, and it's contrarian to and inversely related to the S&P. Last week, I talked about that specifically and how they're inversely related, and I said that the VIX would move up. Now, I didn't think it would move up this dramatically, because you can see here we have my forecast line with the end of the line being my target. But look what's happening to the VIX. Let me erase all these lines here as well so you can see this again more clearly. Just clean the slate. Right here from the highs back on May 31st and June 3rd, I can draw a horizontal flat line right there. That's called resistance. And today we slightly breached that resistance but pulled right back down. This is an inverted hammer. So if the VIX is expected to drop, and I think it will, I'll pull back to that 20-period moving average, that will most likely cause the S&P to rally. All right, so again, remember they're inversely related. And the stochastic showing overbought with a hinge lower. The CCI showing overbought, hinging lower. See that pivot point right there? So again, if the VIX goes down, the S&P will most likely go up. Now, last week in the market report, right around 2 minutes and 37 seconds, I talked about the S&P and the relationship. I did not show the chart because, I think common sense tells us that if they're inversely related, and I'm saying the VIX is going to go up, the S&P will go down. Well, guess what? That's exactly what happened. Look at the SPY. As I zoom in, you'll see that we wound up very close to my target support level back here from a couple of weeks ago. This is a gap fill target. It is now filled. You can see that my forecast from the week before was that we would pull back to fill that gap. It has now done that. So let me erase these lines, clear this chart up again. And the same story as the diamonds. We have a wide divergence from the 20-period moving average. We have a long shadow under the candle. The gap is filled. We have support down here as well. I'm enjoying the flat line support line right there because I think we're going to bounce off of that just like that and pull back to the 20-period moving average. The drop in volume tells us the sellers are becoming less motivated. Stochastics are right at oversold. CCI is oversold. I'm going to forecast that the CCI will go back up and form a buy signal there. So again, the SPY looks very bullish. Now let's look at the tech sector. QQQ, that's the Qs. Again, same thing as the S&P, the Dow, everything, all the same. Look how amazingly perfect this moved to that gap fill point. Look at that. Now, keep in mind, there's another support level down here, and there's a slight open gap down here. Can those fill? Absolutely, they can fill. Do I think they're going to fill next week? No, that would be too much of a dramatic sell-off, and I don't think the trade war news is that negative that it would cause the tech sector to get slammed like that. I think that once I erase these lines, you'll see my clear forecast lines coming out there. That is going to be the same as the diamonds and the SPY. I think we're going to snap right back to the 20-period moving average. CCI, again, I think will move up, creating a buy signal. And that is the story for the Qs. Looking at a more broad-based index, the Russell 2000 obviously is covering 2,000 stocks. Same thing. The end of the line was my target, but guess what? We blew right through that target. My forecast for the Russell 2000 was different than what it was for the diamonds, the Qs, the spiders. I said that the Russell 2000 would most likely go up first before pulling back. And look at that. Here was my forecast. It moved up, hit my target here, reversed, pivoted, and hit the target on the downside right there. Same scenario. Although this is not a hammer pattern, it is a long shadow under the candle that tells us that the buyers fought back towards the end of the day. If I draw a flat line support level right here from these lows, I believe that that support will hold. However, we don't have pivot points on the CCI and the stochastics just yet. I think that the Russell 2000 could actually go a hair lower on Monday, maybe Tuesday, before rallying. Again, a little bit different than my forecasts in the other markets, but we've been right a lot of the time. A high percentage of accuracy with the market guys, not right 100% of the time, but you don't need to. If you're right the majority of the time and you are managing risk correctly and using the 1% rule that I talk about on our website right here, I'll show you. Go to the video page on our website and scroll down to the 1% rule. If you're using the 1% rule for managing risk, and let's say you're flipping a coin, all right, 50% of the time you're going to be right, 50% of the time you're going to be wrong. But when you're wrong, you're only allowing your account to lose 1% of its value. Now, if you're using technical analysis and you're letting your profits run, there's a very good chance that you're going to make more than 1% on those other trades that you're right 50% of the time. Again, I'm using a 50-50 rule here, right? If you follow that simple mathematical equation, you're going to make money. Now, with our percentage of accuracy, it's a lot higher than 50-50, obviously. But if you are applying the technical analysis and putting the odds in your favor, like we do all the time, and you trade the gap, like here's a video that teaches you the 80% rule on gap trading, and you know about role reversal, and you start to recognize head and shoulders patterns and double tops, double bottoms, and you learn about all these things, you're going to stack the odds in your favor. All right, so that's as simple as we make it at the Market Guys. Last week I said that we had one mentoring spot open. That is now filled, so we don't have any spots open. If you are interested in mentoring, you want to be put on the waiting list, then all you have to do is click on the contact link right there. That will get an email to me via our office, and I would love to set up a call to talk about whether or not you're qualified and what your goals are, and whether or not you're interested in trading options or equities. We want people to be comfortable in our program, and we can talk about that. So have a great weekend, and I will talk to you next week. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.